Hey traders, welcome to Top Tier Outlook. We're kicking off the week of March 11, and we're going to take a look at the bigger picture of what we will be trading and what we will be managing, and hopefully a glimpse into what kind of price action we could take advantage of as, gosh, it's unbelievable. We're into the third month of the year, and what a year it's been. I keep thinking about opportunity cost, and I keep seeing a lot of bearish analysis and bearish doomsday talk. And it breaks my heart because this is the kind of year that we've been waiting for. We collectively, as traders and investors, for probably, well, gosh, last year was actually quite bullish. Obviously, as you're hitting brand new highs to wrap up the year, you're looking at a bullish year. And yet the bearish, oh my gosh, the top is in talk persists. And this is really something I'm doing my best to combat. I'm doing my best to share the data and the price and what we're doing in the Sector Secrets Mastery so that people won't continue to miss the amazing opportunities that we continue to get in this current environment. Is it everywhere? Is this the buy everything markets of 2020? Of course not. Those were historic actions taken by the Federal Reserve and the Treasury. And those were moves that we may not see again for a really, really long time. But uptrends exist, right? And I have not seen uptrends as sort of naysayed and doubted as the ones we actually have, right? Price action is moving higher. And S&P uptrend has been in place, as we can see here, rather firmly since the last week of January. And yet we still have very bullish action, right? We've had bullish action since November of last year. So even when we get a little wobble in the trend, please remember this. Rather than thinking a trend wobble is somehow a reversal, think about it as continuation. I don't say this without evidence that this has continued to work for the past, well, we're coming up on an entire year. If we want to go back to April of 2023 as when we really had everything in line for a bullish environment, that's continued. So we're darn near coming up on a year of an overall up market. And yet I continue to hear folks warning about significant moves lower. Now, this is where this gets painful. And by the way, unprofitable. Take a look at the overall movement in the NASDAQ. I like the S&P better. I'll talk a little bit about the sectors that are on my radar. I like the S&P a little bit better because I don't have to be as reliant on just a few individual names that are driving just a handful of sectors in the NASDAQ higher. SMH had a rough day. Now, this is not a trade, gang. I look at folks saying, well, see, we're going to pull back. But look at the overall movement of the year. This is a symbol that started the year off right around $170 and moved up to $240. And yet somebody out there is going to say, oh, look at that $20 pullback. How about the overall movement of 70 points, right? If we want to step back and look at it in that regard. And that's the battle you will always have to wage with what's being said and analysts and ideas out there versus what's actually happening. The only folks who are waiting for a significant move lower are the ones who aren't already long. And that's just going to be a painful fact that hopefully everyone will catch sooner rather than later before this kind of analysis just frankly poisons your mind. XLC is the second strongest sector in the NASDAQ. But much like the semiconductors that are largely being carried by NVIDIA, we see that within the communication sector, XLC, Meta has been doing most of the heavy lifting. Netflix has been doing most of the heavy lifting. And we've had actually very, very good trade results with Disney, right? Disney's further down the list, not as a tech heavy type name, but certainly something that benefits from the overall rising tide. And that really is the theme, gang. We have an overall rising tide in this environment. Nothing about non-farm payroll undid the overall uptrend. Nothing about Chairman Powell's 2 days of testimony undid the overall trend. And by the way, if Powell wanted to course correct expectations about whether or not the Federal Reserve was going to cut specifically at the June meeting or in 2024 at all, where, by the way, what is being discounted, and he knew this too, before he stepped up to the mic for those 2 days of testimony this previous week, he knew that, again, we collectively as traders and investors have discounted 3 to 4 quarter point cuts by the end of this year. So by the December meeting, we're expecting 3 to 4 quarter point cuts. from where we are right now, which is that 500 to 5.25 level. All right. So knowing this, if he thought to himself, and believe me, they don't want to shock the market. I know we have our opinions about the FOMC chuckleheads, right? I like to call them chuckleheads, but they don't want to shock the market. Their goal is not to say one thing and do another. That has not historically been the aim of any Fed chair. This particular Fed chair learned the very, very hard way in the early part of his tenure that if he ignores the Fed fund futures, if he ignores what target rate probabilities are showing, he can cause a lot of harm. So when folks say, well, Rug, why can't he ignore it? I always like to remind folks that may not remember or weren't trading in Q4 of 2018 and Q1 of 2019 and don't remember when Powell ignored the target rate probabilities and hiked anyways when target rate probabilities were waiting for the pause from the Federal Reserve. It began one of the swiftest downtrends, one of the swiftest sell-offs that we had seen at that time. In modern markets, very few sell-offs were as merciless as that one when the Federal Reserve did not view the opinion of the target rate probabilities as our view, ignored it, and traders and investors had to undo all the expectations, which means the rally that was preempting a pause. It didn't come. So I don't think he's going to do that again, right? And by the way, neither do bonds. Bonds are not positioning themselves in a way that's reflecting two things. Bonds like to make sort of reflect two things, make a bet on two things. One is monetary policy coming in too late or ineffectively, because if it does, yields stay high, which is to say the ZB and the TLT markets stay heading lower, right? That's not what we have. So bonds are fairly convinced, okay, we're going to get a cut and the waiting to June is not going to undo the economy, right? Gold has been rallying because gold reacts to something called real yield or real interest rates. Real yields are the difference between the nominal yield of a bond, usually on the shorter end of the yield curve, 1 to 3 years, and the rate of inflation. So when that widens and when that narrows, gold responds to that. And when it narrows, gold goes up. Or when that real yield goes down, gold goes up. It's an inverse or negative relation. What this once again says, oh, we're expecting lower rates and inflation staying steady, if not moving lower, right? And so that's where we sit. The evidence we see is there. Let's take a look at another place, right? This is never what I think. This is never what I feel, right? This is all about where can we look at the data? Where can we look at inflation, jobs, and the other symbols that also are looking at inflation and jobs and say, hey, this is what's playing out there. All right, so take a look at 6E. This is actually the best way to look at the dollar. Far better than UUP, far better than the DX futures, far better than the DXY. Why is that? Because the dollar is actually a basket. When folks say, hey, I'm looking at the dollar, that's actually incorrect. Whether they know it or not, it's actually incorrect. It's a dollar basket. It's the US dollar's value versus a basket of other currencies. This applies to DXY, UUP, DX futures. When I look at the 6E, I'm looking at the heaviest weighted currency in that basket. So even though there's 6 currencies in that conversation, this one is 58% of the basket. So most of the way in which the dollar moves is a negative or inverse correlation to the euro. So why not just look directly at the euro? And this is the relationship of the euro versus the US dollar. And take a look at that euro. If the euro's moving higher, that means the dollar's moving lower. And the euro's above the 200. So it's in the bullish hemisphere, which puts the dollar in the bearish hemisphere. Is it in an uptrend? Oh, gosh, no, right? Because remember, the European Central Bank, the Central Bank of Europe is going to have its own dovish pivot eventually soon too. But the US dollar is weaker than the euro. And that, again, is another signal that we're coming into a central bank that's ready to cut. When a central bank cuts rates, the currency of that country, think of it as the stock of that country, actually weakens, right? That's by design. That's the way it works. And so that's what we're looking at here. There is no sign that we're actually looking at something that we can plan, that we can trade and say, oh yeah, the market's getting ready to roll over. So what else can we look at? I mentioned that the S&P is my favorite. Let's look at why. If we take a look at the S&P, aside from the XLK, it's financials. Now, XLK, by the way, does not look so good. I'm not fond of this structure. Even though it's heading higher, the top two weighted stocks, if we understand sector weighting within the context of how stocks move and within the context of how the sectors influence the indices. So it's a hierarchy: index, sector, stock. Get that alignment, which is what we've been doing all year. And you might be saying, okay, Rag, and you know what? If you're thinking this, I can't see hands, but I wish I could. I wish we were all in the same room talking about this. If you say, okay, Rag, I get what you're saying. You don't like Apple. You don't like Microsoft. You're focusing on some other places. But how's that working out for you, right? Are you growing your account on the absolutely, parabolic rocket ship moves of NVIDIA or SMCI? Indirectly, we've taken advantage of NVIDIA, but by taking advantage of all the strong stocks that are in semiconductors. It's not just an NVIDIA story. It's a Taiwan semi story. It's other stocks moving higher. And one of the best, most affordable ways to do it, where we have liquidity and we have affordability in terms of buying the individual options, is to buy the SMH ETF. So SMH is primarily NVIDIA, but it has Taiwan Semi and all those other semi names like AMD that we know and love. Okay, so that's probably about as attached to the NVIDIA story as I've been. The rest of the time, we're focusing on things that, well, frankly, are just going to be very boring and trend very gradually higher. One of the best trades we've had over the past 2 and 3 months, and I mention that because it's not like we're one and done. We get in and we roll higher with the uptrend, whether that's American Express, GE. These are all symbols that we have multiple entries in, not once, but getting in 2 and 3 and 4 times. We continue to push our advantage in places that have that strength. Financials are a great place to look for that strength. Industrials are another, right? We don't have to be tethered to what's NVIDIA or SMCI doing next. I could care less. My book is not full of stocks that are just having maybe a once in a lifetime move, or at least maybe a once in 2024 kind of move. My book is based on things that are going to happen consistently again and again, so that once those stocks are done having their fun, right? What's next? What do we do in April? What do we do in May? What do we do in June? Is it still just about NVIDIA and SMCI? I think we all know it's probably not. So how do we find that index sector stock alignment for that consistency? And so like I like to tell folks, it doesn't matter what I say. It only matters what I do, right? We talk about this in the mastery a lot. So what I do on the weekends, once to twice a month, is I'll upload my trades that we've taken in the mastery, the Sector Secrets Mastery, and I'll put them into this thing called TradesViz. Now, don't get hung up on the software. It's not about TradesViz alone, although I do like this software very much. Wingman Tracker is great. Trader Sync is great. There's a number of them. Trade Metria is quite good. I will tell you, Trade Metria I like for futures. Trader Sync is good for futures and options. If you do a lot of multi-leg options trading, Wingman Tracker is probably going to be what might be best. But I really like TradesViz because I'm long calls, long puts, and my futures trading. And this works out really, really cool. And I like the visualization it gives me. I just don't want to know what I made in the month. I can look at my account and see that, right? But the ending P&L doesn't tell you as much. What I want to know is, what kind of losses did I have relative to my wins? Am I looking at a lot of single outsized wins that are cushioning a lot of smaller errors that I'm making consistently through the month? I can look at the breakdown of February and say, no, I had a couple losing, segments of time throughout the month, but for the most part, my winners were bigger than my losers. That matters. And they weren't outnumbering my winners. All right, what else? I want to look at my win rate and so forth. So I can see that the very beginning of the month until about 3 weeks in was just a rocket ship, and then things started to level out. Well, what happened the second half of February? Was it an error in my trading, or can I go back in my notes and say, oh, we actually started to reduce our activity. We got caught up in a couple dips. Taiwan Semi is one of them. SMH is another one where I got stopped out. Even though directionally I was right, I did get stopped out of some trades. So I can see where things sort of leveled out towards the end of the month, right? My win rate is exactly where I want to see it. We don't want to see 80+% win rates. I know folks think, Rog, our win rate, the higher the better. That's actually incorrect. We don't want to see the higher the better win rates. What that means, oftentimes, a really high win rate typically means we're taking profits off the table too fast, right? And a really low win rate means, obviously anything lower than 55% is really no better than a coin toss. So it's not good to have a really low win rate either. A lot of folks say, well, I've got a style that could win 1 times out of 10. My thought is, why are you doing something with such a low probability of success, right? So I'm not a fan of that either. But I have found a healthy win rate is somewhere between about 65, 67 to about 72, maybe 75%. And that means that I'm getting into things. I'm taking losses as I well should, but because I'm not smothering my trades, I'm able to get some really good account growth. All right. So that's exactly what we're talking about here when we break this information down. So, this is just the month of February. We did this for the month of January when we did our trial promo. I'm going to continue to do this as we go through March. I love data like this, right? It gives me an idea of what I've been doing. And this is a little dip I had, and then we actually finished the month pretty darn strong. Actually, this takes me into actually early March. So this is all that matters, right? Am I going to pluck out 1 or 2 really good trades? Yeah, we had some great trades in GE, had some great trades in American Express, had some big wins in Disney, right? But it's not about single wins, right? I'm never going to talk to you all about, hey, I made this % on this trade and that. Rog, when you were wrong, how bad did it hurt? When you were right, how well did it go, right? So I like to talk about throughout the entire week, all the trades, not just through the week, but through the month, and then focus on, is the account growing, right? And I had my account growth t-shirt on all day long. For whatever reason, I took it off before the show. I'll have to put it on tomorrow for Charts and Coffee. That is it, gang. Account growth. That's the standard I hold myself to. That's the standard we have to hold each other to. So we'll continue to, let's see. I have some of March here. Yeah, a little bit of March. Yeah, so I don't know why it's not aggregating yet, but I did upload last week's trade, so I have to see why it's not aggregating yet. But I'll have more information on this as we go through the month of March. I mean, that's the point, gang. The whole point is to make sure that whatever we're doing, we're not risking too much when we're wrong as to blow up our account, but that we have that steady growth. Anyways, that being said, a lot of folks ask, Rog, okay, we get you're talking index sector stock. You're telling us we don't have to grow an account with the likes of SMCI and NVIDIA, which is absolutely true. Where are the wins coming? So that's what I'm going to say. Focus on XLI if you want to kind of steer clear of tech. Focus on XLF because this is really 2 of the best sectors nobody's talking about, right? What's happening in financials, what's happening in industrials. And then I'm going to show you one other thing before we wrap up the show. And that is looking at, here we go. I love this site. This is Coifin. I'm going to show you what the U.S. sectors look like. We're going to be talking about this a lot more in the top tier outlook. What is outperforming quarter to date? Here's your SMH. Here's your communications, but there's financials. Tech is in there, but not because of Apple and Microsoft. The number 3 weighted name in tech in XLK is NVIDIA. So it's right back to this SMH conversation. But what about healthcare? What about industrials? Lilly continues to move higher. That's your number 1 weighted stock in healthcare. Energy has had a really good transition from the bearish to the bullish side of relative performance. So now it's time to keep an eye on things like XLE itself and the Exxon, right? The Exxon weighting in XLE is the number 1 weighted stock. So we're actually starting to do more in XLE. Our first trade in XLE was a quick win in Chevron, but Exxon in the meantime has started to outperform. And that's where we're going to continue to keep our attention. So here's XLE, right? Which, by the way, is very much being influenced by the strength in crude oil, right? It's not all about tech and semiconductors, gang. It doesn't have to be. Here's XLE, right? And here's Exxon, all right? Now, we are gearing up to do 2 pretty big things because this has been a big reason as to the success rate that we've had in the mastery. One is we're looking at the way we are defining what a trend and chop is. This is the first big redesign that I've ever done in my career of, hey, what are the metrics? What are the factors that I will use to say, hey, this is an uptrend, this is chop, this is a downtrend, or this is bullish momentum, this is neutral momentum, or this is bearish momentum. So we've retooled that. The other thing that we're also doing is really paying a lot of emphasis to index sector stock to the point where it will keep me out of a trade if I'm just sort of trading a lone stock, having a great moment, right? The alignment that's working, the alignment that continues to work, not just this year, but at the end of last year is, are we seeing strength in the index? What are the outperforming sectors within it? And then what are the outperforming stocks within it? And if we can just rinse and repeat, right? If we can just rinse and repeat, we're in good shape. So I'm not bearish, right? I'm not bearish. The most important thing to remember is the opportunities that we're going to get, whether that be NVIDIA or whether that be the S&P, the opportunities that we're going to get are going to be built upon whether or not we can be patient enough, gang, to buy a dip, right? Can we be patient enough to sit on the sidelines and take advantage of a buy the dip? Now, I'll give you a great example. This is the last trade that we put on last week. We're long the SPY. Friday, oh my gosh, the world's coming to an end, or whatever such bearish nonsense gets relayed, right? We sunk into the range where I know there's a high probability of follow through. I say probability, gang. There's no guarantees. They call it fishing, not catching, and that could be applied to trading too. So we put on a trade in the S&P. And what I'd love to see is this ES continuing to move higher into tomorrow's open, in which case, I mean, look at this beautiful gap up. That's going to serve me really, really well. And here's why. And I'll wrap it up here. Here is why. And maybe a lot of traders might say, gosh, Rag, I never thought of it this way. Let me show you something. There is a big difference between getting long in this part of the candle, which is the, near the high, all the wick, and getting long in this part of the candle, right? The difference is there's really no benefit, right? There's very little upside as compared to that. That's the difference a dip makes, right? So when we take a look at what will happen with SPY in the morning, we'll take a peek at what kind of action we get, right? But ultimately what we want to see is that as long as if the S&P is moving higher, it's going to carry the SPY with it. We'll see what kind of move we get first thing, right? Those are things we got to keep an eye on. Now, the last thing for this week is we're going into March 15. So March 15 means we're going to be seeing our expirations, right? So not only are we going to start to see expirations, we're going to start to see our different contracts roll. Because right now we're still in the H contract, and we're going to start to see the pit date. We're going to start to see or the roll date, and then we're going to start to go into expiration, the triple witching of this week. So ultimately, gang, what we have is a lot of strength, right? A lot of strength as we move higher. Okay. And what we want to see is where the SPY is sitting. Now, remember, as we kind of have our hand off from ESH to ESM, the real question is going to be, does this continue to show that we're seeing overall strength in the NASDAQ, overall strength in the S&P? And gosh, gang, Dow is one of those sectors we can't ignore, because if industrials are moving higher and if financials are moving higher, that disproportionately benefits the Dow and the S&P. Movement higher is movement higher, gang, and the ETFs are going to key off those levels. All right, so that's it for me. Sorry I rolled over a little bit today. I will see you all on, here we go. I'll see you all on Monday for Charts and Coffee. Let's see what our open looks like tomorrow, and we'll go from there. Be good to each other, gang. I'll talk with you soon.